There is a well-known trade-off sitting at the heart of every covered call ETF you have ever looked at. You buy into the fund, you get the monthly income, often impressive monthly income, delivered consistently into your account, and in exchange for that income, you give up a portion of the upside when the market rips higher. When the S&P 500 charges forward 25% in a year, your covered call fund captures maybe 12 or 15% of that. The income was real, but you left money on the table. That is not a bug in the strategy. It is the fundamental design. Covered call funds cap your upside in exchange for premium income. That has always been the deal. For a lot of income investors, that trade-off is perfectly acceptable. You came for the monthly distributions, not for full market participation. But over the last 2 years, a significant number of investors have been asking a different question. Is there a way to get the monthly income of a covered call strategy without sacrificing quite so much of the upside? Is there a way to get closer to what the market actually returns, while still running the covered call income engine on top of it? NEOS heard that question from a lot of investors, spent over a year building and testing their answer, and launched the result in early 2026. 3 new ETFs under the X ticker: XSPI, XQQI, and XBCI. The boosted series. Today I am going to walk you through exactly what these funds are, how they actually work under the hood, why NEOS chose the specific leverage structure they did over other available options, what the target income ranges look like, how they are expected to behave in different market environments, and who they are and are not designed for. This is a complete breakdown: mechanics, tax treatment, risk profile, distribution targets, and the honest conversation about what leverage means in a down market. Let us get into it. Before I explain what the boosted series is, I need to make sure the foundation is solid, because if you do not fully understand how NEOS's core covered call strategy works, the boosted version will not make complete sense. NEOS has 3 core income ETFs that have been around for a few years now: SPYI tracking the S&P 500, QQQI tracking the NASDAQ 100, and BTCI tracking Bitcoin. Each one earns its monthly income through covered calls. The fund holds the underlying equities, or Bitcoin ETPs in the case of BTCI, and simultaneously sells call options against those holdings. The option buyer pays the fund a premium. That premium becomes the income distributed to shareholders every month. The distinguishing feature of NEOS's approach versus many other covered call ETFs is that they use index options specifically what are called Section 1256 contracts, rather than options on individual stocks or ETFs. This matters enormously for tax treatment. Section 1256 contracts receive a special tax classification where 60% of any gain is treated as long-term capital gains and 40% as short-term, regardless of how long you actually hold the position. Compare that to a fund using daily swap contracts for leverage. Those swaps are technically fixed income instruments held for less than 365 days, so they are taxed entirely at ordinary income rates. The difference between long-term capital gains tax rates and ordinary income rates can be 10 to 15 percentage points depending on your tax bracket. For a fund generating double-digit yields, that tax efficiency is a significant part of the actual after-tax return the investor receives. NEOS has built their entire product line around this Section 1256 structure, and the boosted series continues that approach. The other distinctive feature of NEOS's covered call methodology is that they do not write calls against 100% of the portfolio. They use a laddered dynamic overlay, selling calls against a portion of the portfolio and adjusting that percentage based on what the options market is doing. When markets are calm and volatility is low, generating the target income requires writing calls against more of the portfolio. When volatility rises during market turbulence, option premiums increase, meaning less of the portfolio needs to be covered to generate the same income. This dynamic adjustment is the mechanism that allows NEOS to target a consistent distribution range, rather than letting distributions fluctuate wildly with market conditions. SPYI targets 10 to 12% annually. QQQI targets a higher range reflecting the Nasdaq's higher volatility and therefore higher option premiums. Understanding this dynamic overlay is essential to understanding how the boosted series builds on it. Here is the problem the boosted series is designed to solve, stated in the simplest possible terms. A covered call strategy gives up the top portion of the return distribution in exchange for income. Think of a bell curve of possible market outcomes. The covered call fund collects premium income by agreeing not to participate in the far right tail, the really strong up moves. In a year where the S&P 500 returns 25%, a covered call fund on the S&P 500 might return 12 to 15% because it sold away its right to participate above certain price levels. The income was real and tax efficient, but the investor gave up 10 to 13 percentage points of upside to get it. For investors who specifically came to the covered call strategy for the income and do not care about matching market returns, that is fine. But for investors who want both the income and something closer to full market participation, the only mathematically valid way to close that gap is to use leverage. You cannot get more exposure to an asset you have agreed to cap without adding more underlying exposure. That is the core logic behind the boosted series. Take the existing NEOS covered call framework, the index options, the laddered overlay, the Section 1256 tax treatment, the monthly distributions, and add a layer of synthetic leverage that increases the underlying exposure from 100% to approximately 150% of the notional portfolio. More underlying exposure means more upside participation when markets rise. More underlying exposure with more call options written against it means more income generation potential. The fund is essentially running a covered call strategy on 1.5 times the index rather than on the index itself. Let me explain the mechanism NEOS uses to achieve that 150% exposure, because the how matters a lot. And it is different from every other leveraged product most investors have seen. Most daily leveraged ETFs use swaps to achieve their leverage. A daily swap is a contract with a bank where the bank agrees to pay the fund the leveraged return of the underlying index each day. The fund gets precise, guaranteed leverage. But that precision comes with 3 significant costs. Counterparty risk, because you are dependent on the bank honoring the contract. Full ordinary income taxation, because daily swaps held under 365 days receive no preferential tax treatment, and embedded fees and commissions built into the swap's pricing. For a product that is supposed to be held long-term, daily swaps are a structurally expensive and tax-inefficient way to achieve leverage. NEOS instead uses what they call a synthetic long position built from index options, specifically a put-call combination. The fund sells an index put option and uses the proceeds from that sale to buy an index call option at the same strike price and duration. Selling the put and buying the call together creates what is called a delta-1 synthetic position, a position that moves essentially 1-for-1 with the underlying index, just like owning the shares directly. By sizing this synthetic position alongside the full physical equity portfolio, the fund achieves approximately 150% total exposure, 100% from the physical equities plus approximately 50% from the synthetic position. This synthetic leverage is built using the same Section 1256 index options that NEOS uses for its covered call overlay, which means the leverage component inherits the same 60-40 long-term to short-term capital gains tax treatment rather than being taxed as ordinary income. That is a structurally meaningful advantage for the long-term investor who holds this fund inside a taxable account. The synthetic position is rolled quarterly rather than daily, which reinforces the buy and hold character of the product and avoids the compounding slippage that daily rebalancing creates in traditional leveraged ETFs over longer time periods. Now let us look at each of the 3 funds in the boosted series individually, because while they share the same architecture, the underlying reference assets, the S&P 500, the NASDAQ 100, and Bitcoin, have meaningfully different risk profiles and income characteristics. XSPI is the NEOS-boosted S&P 500 high-income ETF. It builds on SPYI, NEOS's S&P 500 covered call ETF, which targets 10 to 12% annual distributions. With 150% exposure, XSPI targets approximately 15 to 18% annual distributions, roughly 1.5 times the SPYI target, which is the direct mathematical result of running the same strategy with 50% more underlying exposure. The fund holds all the stocks in the S&P 500 index directly, full physical replication, and overlays the synthetic position and covered call strategy on top of that physical portfolio. The expense ratio is 0.98% compared to 0.68% for SPYI, reflecting the additional operational complexity of managing the synthetic leverage component alongside the options overlay. Current share price as of early March 2026 is approximately $47.98. XQQI is the NEOS-boosted NASDAQ 100 high-income ETF. It builds on QQQI, which targets a higher distribution range than SPYI because the NASDAQ 100's higher volatility generates larger option premiums. XQQI targets approximately 19 to 23% annual distributions, again roughly 1.5 times the QQQI target. The fund holds all 100 stocks in the NASDAQ 100 directly, with the same synthetic overlay and covered call structure. Current share price is approximately $47.43. The higher target distribution range reflects both the NASDAQ's inherently higher volatility and the amplification effect of the 150% leverage. Investors choosing XQQI over XSPI are accepting higher volatility on the underlying index in exchange for higher income potential. The same trade-off that exists between QQQI and SPYI in the core lineup. XBCI is the NEOS-boosted Bitcoin high-income ETF. And this one has a slightly different construction due to the unique nature of Bitcoin as an asset. Because Bitcoin does not have the same exchange-listed index options infrastructure that the S&P 500 and NASDAQ 100 do, there are no Section 1256 Bitcoin index options. NEOS uses a different mechanism for both the base exposure and the boost. XBCI holds spot Bitcoin ETPs through a controlled foreign corporation subsidiary and uses options on Bitcoin-related instruments to create both the underlying exposure and the synthetic leverage component. The tax treatment for XBCI differs from XSPI and XQQI as a result, so if you are considering XBCI specifically, I would strongly encourage you to read the prospectus carefully and consult a tax professional regarding your specific situation. What all three share is the 0.98% expense ratio, the monthly distribution cadence, and the approximately 150% notional exposure target. One of the most important questions any investor should ask about the boosted series is, what happens in a down market? Because leverage is exactly as powerful on the downside as it is on the upside. If SPYI is down 1% in a month, XSPI is targeting approximately 1.5% down. If the S&P 500 drops 20% and SPYI drops 15%, XSPI is targeting a drawdown closer to 22 to 23%. The leverage does not pause during corrections. NEOS is explicit about this. They are systematic and rules-based, meaning the fund does not make active discretionary decisions to reduce leverage when the market looks dangerous. The 150% exposure is the structure, and it runs through all market conditions. What does change during market sell-offs, and this is a meaningful feature, is the covered call overlay. NEOS's dynamic approach means that as volatility rises and markets sell off, they write less of the portfolio against covered calls and write those calls further out of the money. The practical effect is that during a sell-off, more of the portfolio is left uncovered and positioned to benefit from a rebound. The covered call income is maintained at the target range because rising volatility means option premiums are higher and generating the same income requires selling fewer contracts, while more of the portfolio is freed to participate in recovery gains. This is the same methodology SPYI and QQQI use, just with more underlying exposure. It does not eliminate the downside risk of leverage, but it does mean the fund is not simultaneously capping its recovery potential at exactly the moment the market needs to bounce back. The other risk management mechanism available to investors, and NEOS is very clear about this, is the ability to shift between the three tiers of their product lineup. If you hold XSPI and believe a significant correction is coming, you can move your position into SPYI, the core covered call version with no leverage. If you want even more downside protection, SPYH, the hedged version, carries approximately 1/3 to 1/2 the market risk of a pure equity position. The entire NEOS product architecture is designed around this flexibility. Boosted for maximum risk on exposure, core for balanced income and participation, hedged for defensive positioning. Investors can shift between them as their market view and risk tolerance evolve. What NEOS does not do is make that call for you. The products are rules-based and systematic, and the decision about which tier is appropriate for your situation is entirely yours. There is a misconception about the boosted series that NEOS anticipates, even though these funds are still new, and it is the most important one to address clearly. When most investors hear the word leverage in an ETF context, they think of daily reset leveraged products, funds like ProShares Ultra, S&P 500, or similar vehicles that use daily swaps to deliver 2x or 3x the market return each day. Those products are designed for short-term tactical trading. They suffer from a well-documented phenomenon called volatility decay, where the daily compounding of leveraged returns in a choppy market erodes returns over time, even when the long-term direction is flat. They are not buy-and-hold vehicles, and most of their issuers explicitly say so. The boosted series is structurally different in almost every meaningful way. The leverage is not reset daily. It is reset monthly alongside the option overlay. The synthetic long position is rolled quarterly. There is no counterparty exposure to a bank swap. The tax treatment is Section 1256 rather than ordinary income. These are long-duration, buy-and-hold structures that use leverage the same way an institutional portfolio manager would, as a long-term allocation decision, not a short-term trading tool. The practical implication is that the compounding dynamics of the boosted series over multi-year periods are meaningfully different from daily reset leveraged ETFs. The monthly reset structure reduces the volatility drag that erodes daily reset products over time. It does not eliminate it. Leverage is still leverage, and in a sustained, volatile, declining market, the monthly reset version will still compound negatively. But over the kind of rolling multi-year periods that long-term investors hold positions, the structural differences matter. Investors who understand this distinction and approach XSPI or XQQI as they would any other long-term allocation, with appropriate position sizing, a genuine long-term time horizon, and the stomach to ride through periods of elevated volatility, are the investors these products are designed for. Let me pull the full picture together and give you a clear framework for thinking about whether any of these three funds belongs in your portfolio. The boosted series is not for everyone, and NEOS is the first to say that. Understanding your own risk tolerance and financial situation is the prerequisite for evaluating any leverage product. But for the specific investor who is already comfortable with the core NEOS covered call strategy, already understands how option-based income works, and has found themselves frustrated that they are giving up too much of the market's upside to get that income, XSPI and XQQI offer a structurally sound way to address that frustration. The income targets are compelling on their face, XSPI targeting 15 to 18% annually and XQQI targeting 19 to 23% are not numbers generated by destructive NAV erosion. They are generated by the combination of 150% market exposure and the covered call overlay on top of it. In a rising market, the fund is participating at 1.5 times the index's gains while simultaneously collecting option premium income on top of that. In a falling market, the fund is falling at approximately 1.5 times the index's losses while the covered call income continues to be generated. providing some offset, but not eliminating the additional downside exposure. That asymmetry is the core risk of the product, and it deserves to be weighted clearly in any allocation decision. For most investors who want to incorporate the boosted series into their portfolio, the logical approach is as a satellite allocation rather than a core holding, perhaps alongside SPYI or QQQI as the primary covered call position, with a smaller allocation to the boosted version for additional income and upside potential. NEOS has specifically noted that blending the boosted and core versions gives investors a way to dial in a customized risk-return profile between the two ends of the spectrum. A 60% SPYI and 40% XSPI blend, for example, gives you a total portfolio exposure somewhere between 100 and 150%, with a blended distribution somewhere between 10 and 18% annually. That kind of blend is the practical application that makes the most sense for most investors who are intrigued by the boosted series but want to manage the leverage risk prudently. The research discipline behind these products is also worth noting because it speaks to NEOS's approach to product development more broadly. XQQI was named Best New Active ETF at the 2025 ETF.com Awards, a meaningful recognition from the industry that their methodology has earned credibility. The boosted series was over a year in development, monitored daily and weekly against internal targets before it was ever brought to market. That is not what you see from ETF issuers who are rushing products to capitalize on a trend. It is the profile of a firm that builds products it believes in and is willing to stand behind. That confidence in the product development process is a relevant data point when you are evaluating whether to trust an issuer with your capital. The three tickers to know are XSPI for S&P 500 boosted income, XQQI for NASDAQ 100 boosted income, and XBCI for Bitcoin boosted income. All three carry a 0.98% expense ratio. All three target 150% notional exposure. All three pay monthly distributions. XSPI and XQQI use Section 1256 index options for both the leverage and the covered call overlay, delivering 60-40 long-term to short-term capital gains treatment on those components. XBCI uses a different structure for the Bitcoin exposure and warrants separate tax diligence. As always, none of this is financial advice. Every investor's situation is different, and leveraged products of any kind require you to understand the mechanics before committing capital. Read the prospectus, do your research, and if you have specific questions about how these funds fit your tax situation or risk profile, consult a qualified financial professional. But if you have been watching NEOS products for a while and have been asking whether there is a more aggressive version available, the answer is now yes. And the structure behind that answer is more thoughtful than most leveraged income products in the market today. If this breakdown was useful, hit the like button and subscribe for more content on income ETFs, options-based strategies, and portfolio construction. Drop a comment below with your questions about the boosted series, or let me know which of the three, XSPI, XQQI, or XBCI, is most interesting to you and why. I will see you in the next one.